And the score is elastic. It changes every time something is reported. So you might find your FICO credit score online today, and then you apply for a mortgage and I pull it 3 days later. If something new was reported, my score is going to be different than what you got.
Hi, and welcome to Beyond the Paycheck. I'm Paula Christine. So it was one day last week, I was talking to my go-to mortgage guru, Mr. Marc Edelstein from Russ Mortgage. And we were talking about, because I want to buy a home next year. So we were talking about all the things I need to get ready to go through the whole mortgage process. And it can be a nightmare, I understand, from other people. And so I want to do everything as smoothly as I can. So I thought, well, let's do a podcast and talk about it, because I can't be the only person looking to buy a home in the new year. So welcome, Marc.
Oh, thank you, Paul. Always good to see you.
You too. Oh, I know, because we're on video.
Yeah,
Video on YouTube. Only video on YouTube, not on all the other places you find us. Yeah. So, Happy New Year.
Yeah, you too. Thanks.
I know we talked a little bit last week, and I know I'm going to get pre-approved instead of pre-qualified. So Why am I doing that?
So the difference between pre-qualification and pre-approval is a pre-approval is actually underwritten by an underwriter. They review your income, they review your assets, they review your credit report, and they issue an approval. That's a much stronger approval than a pre-qualification, where you apply with a lender, the loan officer reviews your pay stubs, reviews your bank statement, runs your application through the automated underwriting that all lenders use, and they garner approval. But they have as a loan officer, you have no underwriting authority. So you're saying, based on my experience and the data that I have, you're pre-qualified. You can't really say you're pre-approved, because an underwriter hasn't looked at it. An underwriter is the only one with the authority to issue that approval.
Okay, so if I'm the seller and I've got a couple offers coming in, I would prefer to take the pre-approved person than the pre-qualified, because at least I know that I have a better chance of that going through.
Correct. Not that a pre-qualification wouldn't close. It very well may. And lots of pre-qualification letters get mislabeled as pre-approval letters, right? Because they're issued by the loan officer. Right. But they still close. They close.
So if I get pre-approved, does that make the whole mortgage process simpler?
Much simpler, because credit, income, and assets have already been reviewed by an underwriter. We're really only waiting for you to find the property, and we only have property-related conditions that are remaining to satisfy. So it speeds up the mortgage process, which could make your offer more enticing to the seller, because you need less time to close than somebody else who didn't get pre-approved or have an underwritten pre-approval.
Okay. So first of all, I get pre-approved. I should do that before I even start looking for a home?
Correct. You got to know what you can afford and what to expect in the process, and how much money you need to come to closing with, and how we derive at that amount of money that's needed, for sure.
So I know when we were talking last week that, you were trying to figure out how much the max that I could get a mortgage for, and without going into my personal details. But you asked the question, like, property taxes and insurance. So would I have to have an idea first?
No.
If I'm going to my mortgage broker?
No. Okay. Like, I have an idea. Like, I would ask you questions like, well, where are you searching for your home? And then you give me a list of cities, and based on my experience of 20 plus years and your price range, I can get an idea on what the property taxes are. They're not going to be exact, but we will be in the ballpark. Same with homeowners.
Okay. So I get pre-approved and I start looking for a home. Now, I know people make mistakes, because I know when my daughter was getting her mortgage, the underwriter was questioning, like, if she made a purchase, or where this money came from, or where that money came from.
Yeah.
So what should you or should you not do?
Let me simplify it.
Okay.
Well, not simplify it, but maybe put some logic to it. All of these questions that you're asking can be covered in the 4 C's of obtaining a mortgage: credit, capacity, collateral, and capital. So let's go over those.
Okay.
Start with credit. Before you go and apply for a mortgage, you should research your own credit scores using one of the online resources that are available, whether it's through your credit card, through your bank or credit union that provides credit scores. You go directly to credit bureaus. There's endless amounts of resources. The thing to know about doing that there are 2 types of credit scoring models. One is called a FICO credit score, and the other is a Vantage credit score. The mortgage industry uses FICO credit scoring. So if you're searching and doing your due diligence on your credit profile and credit scores, make sure that you're looking at the right type of scores that the mortgage industry is going to use. The Vantage credit score doesn't really do us any good. And we found
I've never even heard of that. I've never heard of that.
Well, that's what
Vantage credit.
Credit Karma uses, a Vantage credit score.
Okay.
Plenty of other ones do as well. So that's the first thing. Once you do gain access to your credit report, and you can go to like annualcreditreport.com or freecreditreport.com and get a copy of your credit report, you want to look and see if there's any information that's being reported that's inaccurate and work to get those inaccuracies corrected. If there's anything derogatory on your credit report, like a collection for a medical bill or a cell phone bill that went unpaid or whatever, want to address those and get out in front of those, right?
Can I ask a question?
Go.
Okay. So what if I'm applying for a mortgage, and let's say we are applying together, you and me, and I have an excellent credit score and you don't?
Yeah.
So how is that going to be looked at when we go through the process?
Right. So for interest rate purposes of determining an interest rate, we in the mortgage industry are going to use the middle credit score, the lowest middle credit score between the 2 variables.
Okay.
That makes sense? So if you have a 780 credit score and I've got a 680 credit score, my 680 is what's driving what the interest rate is going to be.
Oh, that sucks. So likely if you're in that situation and you can afford to buy it on your own, would it be better for you to do that?
Are we married? If we're married or getting married, and you can support the new mortgage plus the other debt, and you have the trunk, by all means, for sure do that. You're going to get the best financing. If you need that other person's income, either you lower your expectations to qualify for something that you can afford by yourself, or you just deal with the lower credit score, knowing that you're not married to the mortgage. If that credit improves and the interest rate environment is favorable, you can refinance.
Okay, so what was it going to be if we're not married?
It gets complicated because of the marriage. If the marriage was to dissolve, there's a legal way to separate the assets. If you're not married and you purchase a home, let's say you buy it by yourself, but I'm going to move in with you, maybe even give you a chunk of money towards the purchase of the home, and you use that as well, then it gets much more complicated, because if we go our separate ways, I'm going to want my money back plus whatever equity was built in there, or half of the equity, right? And so now we have a problem because there's no legal method for us to resolve this without it just be you and me coming to some sort of agreement.
Can you have a mortgage? I know we're going off the subject, but can you have a mortgage? Like, can I have a mortgage? Let's say we're living together. Yeah. Mortgage is in my name because I have the higher credit score. Yeah. So I get the mortgage in my own name, even though you give me money, but then I put you on the deed?
Yeah.
So then you would be considered owner, right?
I would be considered an owner, but again, in the situation of a dissolution of a marriage, there's plenty of family law that's been passed that describes the different ways for assets to be divided and equalized, right? Okay. Where if we're not married, there's nothing like that. We have to come to some agreement ourselves without really the help of the law or the written law. right? So in instances like that, when there's money from one party that's going into a transaction that they're not going on the mortgage, I would insist that I go on the title afterwards, after you buy the place. And then I would insist that we put together some sort of joint occupancy agreement that basically states what happens to the house if we were to go our separate ways and never get married.
Okay. Good to know.
Yep.
Since I don't have any marriage proposals anyway. So,
yeah.
Okay. So we talked about credit.
No.
Now you're going to talk about, you got one more thing to say?
Talking about credit. So credit scores range 350 to 850. If you have credit scores in the 300 to 400 point range, you're basically non-existent in the credit world, even the 500s. So each of these different loan programs that are available, most of them have minimum credit scores that they require to be eligible. Plus, any lender who originates a mortgage can put an overlay on top of those credit score requirements that maybe increase from, the guideline to something higher because they're more risk adverse. So for conventional financing, which is the type of financing that gets originated the most, you need at least a 620 credit score. For government loans like FHA and VA, for FHA, a 580 credit score. For VA, because it's a veteran-only loan, there really is no minimum credit score requirement, but a lender is going to put an overlay that says we won't originate a VA loan with a credit score less than 580, 560, 600, whatever. It's their choice, right? So you have the minimum credit scores in most instances that you got to meet in order to qualify. All right, cool.
Okay.
So what makes up the credit score, right? So imagine it looks like a pie. Your credit score is 35% of that pie is your payment history on the account that you have. 30% is the utilization of credit that you have available to you that you're currently using. The higher the utilization, then the more negative impact it's going to have on your credit score, right? 15% of your credit score is the type of the length of credit history that you have. 10% is any type of new credit that's recently been taken out and recently reported. That's going to have a bigger impact because it's new. Mm-hmm. And then 10% is the types of credit that you have. Revolving, and it's like a credit card, whether it's a national credit card like MasterCard or Visa or store credit. Installment loans like student loans, recreational vehicles, cars leases, and then mortgages, right? Those are the most common. So if you have a nice mix of those things, then that's also going to help your credit score, but only by 10%. Okay. So that makes up your score. And this score is elastic. It changes every time something is reported. So you might find your FICO credit score online today, and then you apply for a mortgage, and I pull it 3 days later. If something new was reported, my score is going to be different than what you got. Make sense?
Yep.
Sweet. All right. Second C, capacity. So that's your income. How much can your income support in a new mortgage? So let's talk about the income portion first. Not all income is created equally when qualifying for a mortgage. If you have variable income, whether you receive bonuses, commission, overtime, anything that's variable, you need a pretty long established history of that variable income because we have to average it to determine what the average is. 24 months, ideally, nothing less than 12 months. For self-employed borrowers, it's different income calculation than it is for your standard wage earner. And for your wage earner, if you are a salaried employee, it's easy. Salary divided by 12. If you're an hourly employee, it could also be easy if you're getting 40 hours per week. If you work 32 hours one week, 40 hours the next, 36 the next, 38 the next. It's not 40 consistently, so now we're going to average it to determine the average of your variable hours that you work, right? So you got to be careful. Plus, we haven't even talked about the passive types of income like Social Security, pension, any type of support like alimony or child support. all of those incomes, depending on a few factors, mostly how long they're going to continue for, will determine whether or not those are eligible to be used for qualifying.
So if you're recently divorced, saying just now starting to get child support and alimony, is that considered?
It is if it's going to continue for at least 3 years after closing of your mortgage.
Even though it just started 2 months from now or 2 months ago?
You also have to have a history of receipt of that income. So ideally 6 months for conventional financing to show receipt, or 3 months for FHA. But we can talk, I mean, there's all kinds of different ways to get that clock ticking sooner. That's a different conversation.
But different subject. Okay.
Yeah.
So now I've got my credit, my capacity.
Well, you have your income, right? And so
my income, okay.
Your monthly income. And in the mortgage world, we're using your gross income. So your income before taxes to qualify. You pay your bills with your net income. So if you're a wage earner, you're paying your bills with income that has had your withholdings already taken out, right?
Correct, right.
Okay. So what's the ideal ratio of income versus housing expense, or an income versus total housing expense? Right. Okay. So what is the answer?
Is it it's 28 and 28% for mortgage, 36 overall debt?
Correct. You can go.
Yay.
You can go up as high as 50% for total debt. Risk goes up dramatically once you cross 41%. So if you have
But why would you even, why would you, if your debt is that high, that's crazy to consider adding on something. Well, I guess you're already paying maybe rent anyway, so I don't know. Okay, doesn't matter.
Yeah. So we take a look, so those calculations are done by taking that gross monthly income and then dividing it by the liabilities. So like the proposed monthly payment on this mortgage that you're trying to qualify for, plus the minimum credit or the minimum payments of the other items that appear on your credit report. So we propose housing payment plus current liabilities divided by gross income gives you that that debt ratio of 36, 40, 41, 43, 45, whatever it ends up being, right? So anything really above 50 the risk is so high that it becomes a little bit more difficult to get those types of loans approved. All right. Capital. What are the source of funds that are going to be used for purchasing this home? Where's the money coming from? Is it coming from your savings account that you've accumulated over a lifetime or a while? Is it coming from some sort of investment account that you're going to liquidate, or a retirement account that you're going to draw on? Are you going to get a gift from a family member, like a parent or an in-law? Are you going to be eligible or want to think about some sort of down payment assistance program that might be out there for you?
What's a down payment assistance program?
Oh, there's down payment assistance programs for buyers. They help with your closing costs and your down payment. Most of these programs.
I want one of those.
Well, I don't think you qualify, not because it's because a lot of it's income based. So if you make over a certain amount of money, then you don't qualify based on your household size. Right. So it's designed for low to moderate income households. All right. So where is the money coming from to purchase the home? And then what sort of money will be left over after closing? Money left over after closing are considered reserves. And they strengthen loan applications by having reserves. And when we say how much is left over, we're talking about all of your assets combined. We're not looking for you to move money around to have it all in one account. If you've got a checking account, a savings account, a brokerage account, a retirement account, whatever, as long as we have statements for them all, it all gets bundled into one asset amount. And then we subtract out what you need for closing. And that's what's left over as the reserves. Follow me?
I'm thinking.
Yeah.
Only because I'm thinking of myself, and I have plenty of reserve, but that's interesting. I would have thought that they would have wanted you to have so much in savings, like in your savings or checking account, to make sure that you can, once you have the mortgage.
Yeah. So it's like if you have a brokerage account, that's accessible money, right? You'd have to liquidate whatever it is. It probably would potentially create a taxable event. but you have access to that money. When it comes to retirement accounts, if we're using a retirement account for a reserve or we're using a retirement account for funds for closing, we always ask for a copy of the terms and conditions to make sure that that person can actually access those funds for them to be considered liquid.
Interesting.
All right. The last C, collateral. Collateral is the house. All right. So I broke this up in the two paths. When it comes to the house, you'll have a private home inspection done. A private home inspection is a very detailed inspection of the home done by a licensed, certified private home inspector. You can find them from your realtor. You can find a couple of referrals online, but you want to have that private home inspection. You know,
there's so many people that don't do it, and then once they get the mortgage, and then they go in and find mold or find out they're going to need a new roof or something's leaking, and they hit it well. So yeah, that's a definite
for sure
to have that done.
It could be, depending on the size of the house, it could be 2, 3, 4 hours long, the inspection. The inspector will then give you an extremely detailed report of all the different facets of the home. Sometimes it can be extremely overwhelming, especially to new home buyers. They're going to read this report and be like, holy cow, this house is a piece of crap. But in reality, most of the stuff that's in there, unless it's major, and the inspector will point that out for sure, all minor things that really aren't that big of a deal. The private home inspection is not for your lender. Do not share the private home inspection with your lender. We don't need it. We don't want to see it. We don't want to look at it to see all the deficiencies in the house that we are going to finance.
No, but what you do want to do is show it to the seller, and sometimes
you can,
depending on what it is,
for sure,
get some sort of concessions for it.
Absolutely.